Hello and welcome to my YouTube channel. My name is Lucky Owamin and I am a finance and accounting expert. In today's video, we're going to look at IFRS 16 on leases with a focus on right of use asset at cost. Firstly, let's understand some key terms such as lessee, lessor, and a lease contract. So a lessee is the person who is paying to borrow the lease property or asset, while a lessor is a person who owns the lease property or asset that is being rented out. So in a lease agreement, the lessor is the person or party that issues the lease, and the lessee is the person that the lease is granted to. Lessors and lessees enter into a binding contract known as a lease agreement that spells out the terms of the agreement. A contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration, and a lessee recognizes the right of use asset representing its right to use the underlying asset, and a lease liability which represents its obligation to make lease payment over a period of time. So on this slide, we'll be looking at how to measure the right of use assets. That is the initial measurement of the right of use assets. So IFRS 16 says that at the commencement date of a lease, the lessee measures the right of use asset at cost, which includes the following components: the lease liability plus the initial direct cost plus any prepaid expenses plus cost to dismantle or restore the property less any lease incentives being given. Right, so we will look at each component of this right of use asset cost in details. However, the lease liability component will be covered in a separate video, so watch out for that video. Initial direct costs are increment costs of obtaining a lease that would not have been incurred if the lease had not been obtained. So this cost includes commissions, cost of arranging collateral, and payments made to existing tenants to obtain the lease, any legal fees and internal costs that are incremental and directly attributable to negotiating and arranging a lease, and the above are considered initial direct costs only if they are contingent on the origination of the lease. Right, so this forms initial direct. So let's look at the following costs to be included or excluded from the initial direct cost component. Firstly, is like we mentioned earlier, is the commission paid to a real estate agent to get the property, then any legal fees contingent on the origination of the lease or payment to existing tenants to give up their lease. These are all included in the indirect cost component of the right of use asset. Then those are excluded from the indirect cost component are cost of researching suitable property sites, general overhead, and depreciation. So these are all excluded from the right of use, so you don't need to add them to the right of use asset cost. So still on measuring the right of use asset, the other component is the prepaid lease payment. The prepaid lease payments are payments made to the lessor at or before the commencement date. These lease payments are excluded from the lease liability determination. However, they are incorporated into the measurement of the right of use asset cost according to IFRS 16.24 section B. Cost to dismantle and remove or restore an underlying asset at the end of the lease term is imposed by the lease agreement, are also included in the right of use assets. A lessee recognizes a provision in accordance with IS 37, which is on provisions for contingent liabilities and contingent assets for the restoration costs. The lessees incur the obligation for these costs either at the commencement date or as a consequence of having used the underlying asset during a particular period. So if all of these circumstances exist, then the lessee is liable to recognize the provision. So this will result to as an estimate of costs to be incurred by the lessee in dismantling and removing the underlying asset, and also restoring the site on which it is located, or restoring the underlying assets to the condition required by the terms and conditions of the lease. The lease incentives may include payments made by the lessor to a lessee associated with a lease to encourage a lessee to sign the lease agreement, and such incentives may include an upfront cash payment to a lessee, payment of leases costs, for example, moving expenses, reimbursement of cost of a lease, rent-free period plus reimbursement of legal fees. Such lease incentives are deducted from the right of use asset assessment measurement. So we've come to the end of this video, and this is to let you know that I am making a series of videos on IFRS 16. So my next video series will be on restoration and maintenance of a leased asset. Thank you for watching, and please don't forget to subscribe to my YouTube channel, and see you in my next video. Bye.